Okay, so let's not sugarcoat this. The economic data that just dropped is a massive warning flare. We are looking at the biggest loss of jobs in more than 2.5 years, and this isn't some headline you can just scroll past. This is a direct signal that the ground is shifting under our feet, and it's forcing the Federal Reserve's hand. They're being backed into a corner, and their only way out is to start cutting interest rates, and fast. For every single investor out there, this is what you call a pivotal moment. The kind that only comes around a few times in a decade. In moments like these, some people get wiped out because they're caught on the wrong side of the shift. But if you understand what's happening, if you can see the writing on the wall and have a plan, you can position yourself for some truly significant gains. Playbook that has been working for the last 2 years, well, it's obsolete. A new one is being written as we speak. And today I'm breaking down the alarming new data, explaining exactly why the Fed is being forced to pivot and giving you an actionable plan for the rate cuts that are coming. So to really get the scale of what's going on, you have to look past the headline and dig into the reports themselves, and frankly they are ugly. The first report that sent a shockwave through the market was from ADP on private sector for employment. For September 2025, it showed that the US private sector didn't just slow down, it went in reverse. Private companies actually shed 32,000 jobs. Now 32,000 might not sound like a catastrophe, but context is everything. This is the single largest drop in private employment we've seen in 2.5 years. For months, the prevailing story was a resilient labor market and a strong economy that could handle high interest rates forever. Well, that story just fell apart. A single bad report could be a fluke, but this isn't happening in a vacuum. It's the confirmation of a weakening trend that more forward-looking indicators have been screaming about for months. And that brings us to the second and maybe even more worrying report. This one is from the Challenger, Gray and Christmas, a firm that tracks announced corporate job cuts. Think of it as a preview of what's coming. It's not jobs already lost, but jobs that companies have publicly stated they will be cutting. And employers have announced that they are going to cut nearly 946,000 jobs this year. Let that sink in for a second. Almost a million planned layoffs. To give you some perspective, that's the highest year-to-date total we've seen since the chaos of 2020. It's a staggering 55% higher than the number of cuts announced over the same period last year. When you see a jump like that, you have to ask why. The reason companies are giving are the classic warning signs of a recession, economic weakness, and widespread cost cutting. Now, it's easy to blame this on technology, and sure, we've all heard about AI replacing jobs, but while AI was cited for some cuts, the numbers is surprisingly small, only around 17,000 jobs this year. The real story here isn't some futuristic tale of robots taking over, it's the old school story of an economy grinding to a halt. It's about demand falling, business pulling back, and the high interest rate environment finally claiming its victims. The key concept here is what economists call labor market slack. For the past few years, we've had labor shortages, businesses were desperate for workers, and you saw now hiring signs everywhere. There were often 2 jobs openings for every 1 person who was looking. That gave workers all the bargaining power for the higher wages and kept the economy hot. That era is officially over. The data now shows the number of job openings per unemployed person has fallen below 1. Let me put that more simply. For the first time in years, there are more people looking for a job than there are jobs available. The power has swung from the employee back to the employer. This is what a recessionary environment looks like, a market where companies get picky, wage growth slows, and the fear of layoffs makes people spend less. This isn't a forecast, it's happening right now, and it leads directly to what the Fed has to do next. So what does this job disaster really mean for your money? Well, it comes down to one institution, the Federal Reserve. The Fed has a 2-part system known as its dual mandate. First, keep prices stable, which they define as 2% inflation, and second, achieve maximum employment. For the last 2 years, the Fed has been obsessed with part 1. They launched a historic war on inflation, hiking interest rates at a blistering pace to slam the brakes on the economy. Maximum employment was an afterthought because the job market was red hot. They figured the economy could take the pain. Well, the September jobs data proves the job market can't take any more pain. The maximum employment side of their mandate is now flashing bright red. This is exactly why they've just made a massive pivot. At their September 2025 meeting, the Federal Reserve cut the federal funds rate by 25 basis points, bringing the target range down to 4% to 4.25%. This wasn't just any rate cut, it was the first time they lowered rates since December 2024, marking the official end of the hiking cycle and a start of a new easing cycle. Now, the Fed will never come out and say, oops, we went too far. They are a political institution, so they carefully choose words. Fed Chair Jerome Powell called the first cut a risk management move to protect against downside risk to the labor market. Let me translate that Fed speak for you. Risk management is code for we're starting to get scared. They aren't cutting rates from a position of strength, celebrating a victory over inflation. They're cutting from a position of weakness because they see the employment data and are terrified of causing a full-blown recession. They are trying to lower a piano from the 4th floor without smashing it on the pavement. They're aiming for that mythical soft landing, but data suggests that the plane is coming down way faster than they thought. And the market gets it. The market isn't buying the one-off adjustment talk. It's looking at data and it's pricing in a full-blown easing cycle. Right now, future markets are pointing to a very high probability that the Fed will cut rates again at their next meeting on October 29th. On top of that, the market is pricing in a strong chance of another cut in December. If the market is right, and it usually is, about the Fed's general direction, the federal fund rate could fall toward 3.75 by the end of this year. This isn't a small policy change. This is a rapid and aggressive U-turn. It's the Fed hitting the panic button because the jobs data has tied its hands. Of course, some of the more hawkish members inside the Fed are still arguing that inflation isn't beaten and that cutting now is a mistake, but their voices are being drowned out by the flood of weak data. The political pressure to avoid a job-killing recession is immense. The Fed is supposed to be independent, but let's be realistic, they've been forced to choose between the risk of slightly higher inflation later and the certainty of a deteriorating job market now. They've made their choice. They are going to cut. Navigating this world is going to be tricky. The landscape is changing week by week. The investment strategy that killed it when rates were rising is the exact opposite of what will likely work now. If you want to get my latest analysis, see how I'm adapting and to these Fed pivots and get updates on the sectors I'm watching, make sure you hit that subscribe button and turn on notification. You really don't want to miss what comes next. So the conclusion is clear. The job market is weakening and the Fed is cutting rates in response. This brings us to the only question that matters. Now what? How do we use this information to not just protect our money, but to actually profit from this massive policy shift? This is where we go from theory to action. But first, I just want to say I'm not a financial advisor. This is for educational purpose. First, you have to get the basic principles here. Lower interest rates are like a steroid shot for certain assets. When borrowing gets cheaper, a few things happen. It's cheaper for companies to borrow for a new project or to buy back their own stock. For investors, lower rates on safe things like bonds make riskier assets like stocks look way more attractive. Why would you settle for 2% in a saving account when the stock market has much higher potential? And finally, a bit more technically, lower rates increase the present value of a company's future profits. That combination is a powerful tailwind for the market. So where should you be looking to invest? Well, let's break it down. First and most obvious is growth stocks. I'm talking about tech, software, biotech, AI leaders, innovative companies valued on their high growth promise. These are the exact stocks that got hammered when the Fed was hiking. Now that's set to reverse. A falling rate environment is the natural habit for growth stocks. It's time to start looking at leaders in these fields that have been beaten down for 2 years. And second is precious metals, specifically gold and silver. There's a reason gold is called the anti-dollar. When the Fed cuts rates, it weakens the US dollar and makes holding government bonds less attractive. In that environment, gold, which pays no interest, becomes much more appealing. It's a store of value that a central bank can't just print more of. A Fed pivot to cutting rates is one of the most powerful bullish signals for gold. The third area, which is high risk but has huge potentials, is cryptocurrencies. Assets like Bitcoin, Ethereum are classic risk-on assets. They thrive when there's a lot of money sloshing around in the system. When the Fed was tightening, these assets got crushed, but when the Fed signals it's about to turn the money spigots back on, capital starts hunting for high returns, and some of it always finds its way into the crypto space. A rate-cutting Fed is one of the strongest tailwinds for a crypto bull market. Finally, let's talk about the housing market and real estate. The Fed rate hike sent mortgage rates through the roof and brought the housing market to a dead stop. But we're already seeing the pivot's effect. In September, mortgage rates hit a 3-year low. While they've ticked up a bit since, the overall trend will likely be downward if the Fed keeps cutting. Now, mortgage rates aren't directly set by the Fed, but they're extremely sensitive to what the market thinks the Fed will do. As the market prices in more cut, mortgage rates should fall, which should put a floor under housing prices and eventually reignite the market. This also makes certain real estate investments like trust REITs, especially those in growth sectors like data centers, look much more attractive. Now, a huge word of caution, you have to remember why the Fed is cutting. They're cutting because the economy is weak. There is not a risk-free game. If they fail and we slide into a deep recession, lower rates won't save every company. In that scenario, stocks tied to consumer spending could get hit hard as people lose jobs and stop buying non-essentials. And companies with tons of debt could face a wave of defaults. The key is to be selective. Focus on high-quality companies with strong financials and growth stories that can power through even a weaker economy. So let's put a bow on this. The investment playbook from the last 2 years is officially dead. The September jobs report was the nail in the coffin. First, the job market has fired an undeniable warning shot. The data is clear, job losses are mounting and the economy is slowing down. Second, the Federal Reserve sees this clear and present danger and has pivoted. They've started a new rate cutting cycle and all signs point to more cuts coming soon. The era of higher for longer is over. The era of easing has begun. And third, this massive shift creates a new playbook for us investors. The environment is now becoming incredibly favorable for specific assets that have been on the back burner for years. Growth stocks, precious metals, and even risk on assets like crypto, while also providing a potential safety net for the housing market. We are at a critical inflection point. The moves you make or don't make in your portfolio over the next few months could define your financial success for years. This isn't time for panic, but it's absolutely a time for a plan. Stay vigilant, stay informed, and understand the new rules of the game. The next Fed meeting is just around the corner. You can bet I'll be watching to see if they follow through. Thanks for watching, and I'll see you guys in the next video.